Hello, my name is Phil Dunn. I'm a Senior Director in the Thought Leadership Division at Kaufman Hall, a Vizient company. Welcome to Kaufman Hall's Spring Rating Agency Update. A couple of housekeeping items before we begin. First, you may ask a question at any time during the webinar using the Q&A function on the webinar platform. Panelists and moderators will respond to your questions as time permits. Second, a recording of this webinar will be sent to everyone who registered within the next day or two. It's now my pleasure to welcome our three panelists: Suzie Desai, Senior Director at S&P Global Ratings; Mark Pascaris, Senior Director and Analytic Lead, U.S. Not-for-Profit Health Systems at Fitch Ratings; and Dan Steingart, Associate Managing Director at Moody's Ratings. Today's webinar will be moderated by Robert Turner, a Managing Director and leader of Kaufman Hall's Treasury and Capital Markets practice, and by Lisa Goldstein, also a Managing Director in our Treasury and Capital Markets practice. With that, I'll turn the webinar over to Robert and Lisa.
Great, thanks, Phil. Hello and welcome. We're so excited to have everyone join us again today. Thank you for taking time to do that. A lot's happened since the fall when we were able to do this at our conference, and we're looking forward to today's discussion. Hospitals and health systems are beginning to prepare in earnest for the implications of HR1. We want to spend a lot of our time today talking about the strategies that rating analysts are hearing about during rating presentations as a means of helping our audience think through and prepare for the strategic, financial, capital planning, debt access, and other implications in this regard. We're going to touch on artificial intelligence as well as year-to-date financial performance as well. Our hope is that the audience comes away with keen insights for how to prepare for these changes, and so with that, we'll look forward to the discussion. So speaking of changes, Dan, you've been busy. Moody's is undergoing revisions to its to its methodology, and we know you're very busy doing that. So the comment period just concluded, and so I guess you're back in the kitchen making the sausage. And so I think the audience would love to hear sort of, an overview of those changes and your expected, your expectations for the impact on ratings.
Sure. Well, I will do this briefly because we've had a webinar on this. I've had a number of conversations with various market participants, and we could go on for well over an hour easily. But there's a couple of major changes that I want to highlight here, and I'll point out where and what kind of organizations they have the greatest impact on. So first off, this is a significant methodology update. I think most people on the webinar here today are familiar with our scorecard. The scorecard in and of itself is getting a major refresh. We are some of the significant changes that we're making is we are increasing the weight of qualitative factors to 40% from 15%. We have lowered the weighting of revenue just as a standalone item to 15% from 25%. And within the qualitative changes, we're introducing a couple of items that are pretty exciting, including a quality of revenue qualitative factor, which actually replaces payer mix as a quantitative factor. So payer mix will still be important and is a quantitative basis for this qualitative subfactor, but it's not the only item. And just very briefly, the thought process behind that is I think everybody here can appreciate. For example, Medicaid has undergone a significant transformation in how it pays in many states, its relative importance as a payer. So simply saying you have X amount of Medicaid exposure is not sufficient to make informed opinion on the payer mix component of an organization's revenue, because that Medicaid component could actually pay very well in certain states, or maybe has a sunset provision. So you get the idea. So there's other qualitative factors that we've introduced. Also brand and strategic positioning. We're separating that out from operating environment. Right now, under the current methodology, we consider all of that under market position. But really, many organizations have a strong brand or particular particular position within certain service lines or certain components of the market that in and of themselves are separate from the overall operating environment, which reflects regulatory considerations, the labor market in a given service area, or competition, other factors that might be more outside of management's control. So the methodology will allow us to consider those separately. There are also one other major change is hospital districts that issue GO debt. They are currently rated under the general obligation debt methodology. We're bringing them into the not-for-profit healthcare methodology as part of a broader sector-based approach to assigning ratings at Moody's. There's a lot of detail that goes into that. I don't know how relevant that will be for many organizations on the phone today, but just at a high level, we are assigning every organization something called an issuer rating, which reflects their fundamental credit quality, ability to just sort of pay debt and other obligations as they come due. And then separately for the districts, to the extent that they issue general obligation debt, and of course not every district does, there's many districts that only issue revenue debt, but to the extent that they issue general obligation debt, there will be another analysis layered on top of the issuer rating that says, well, what are the fundamentals of the economy and tax base support, and they would be eligible for additional notching above the issuer rating. We put out a request for comment, as you mentioned, Robert. The comment period just ended last week, so we are in the process of reviewing and analyzing the comments and going through the various items that we need to do before publishing the methodology. I expect it will be published in the next couple of months. I can't give an exact date here, but as always, please reach out to me directly or anybody on our team, and we'd be happy to discuss it more depth with any organization if you'd like to. And finally, when we think about the rating impact, for organizations that issue revenue debt, 501c3 hospitals or districts that issue revenue debt, we're not expecting many, if any, changes to those ratings. There will be some changes to districts' GO debt as we incorporate this issuer instrument rating construct. I forgot to mention, for everybody's going to receive an issuer rating. That's your fundamental credit quality. And just as we do now, where we assign bond ratings, every bond or note or whatever the term is for the particular debt instrument will receive an instrument rating, which is really what you already have now. You have a long-term rating, and then if you issue short-term debt, you have a short-term instrument rating, and that'll just be more formally defined, where you have your issuer rating again at the center and these other instrument ratings around it.
Great. Really helpful. And thank you for the quick synopsis. I'm sure you could go on, but I know everybody's interested to see what that looks like when it comes out, and it'll be a topic of conversation, I'm sure. Suzie, I think it'd be helpful maybe just to hear you talk a little bit about what you're seeing. I know in 2025, there were sort of fewer downgrades and more upgrades. I'm curious if you're seeing that materialize into early 2026. And just maybe talk a little bit about the rating activity you're seeing overall.
Yeah, and thanks for having us. Nice to be here. And yeah, 26, another busy year, lots going on. So lots of new sale activity. And it is playing out as we had thought last year, in terms of, we thought this year there would still be a negative bias, but that things would slow down from an activity perspective on our rating actions. So through March, we've had about, and just for context, we have about just under 400 hospitals and healthcare systems that we rate. So obviously we'll review those through the year, but through the first quarter, almost quarter, we've had 5 downgrades versus 2 upgrades. Last year it was about 10 downgrades versus 3 upgrades. So we are slowing that down a bit, but still that negative bias. And then we have 3 unfavorable outlooks versus 4 favorable. And that just means we're either on unfavorable, we're going to negative, or we're going from positive to stable, and sort of the flip on the favorable. So that's also improving as well. So that's good to see. And I would say on the upgrades, just context, none of those I think were related to acquisition. So they're on their own merits. Not that an acquisition isn't, but but it's on his underlying credit quality. And we've maintained about 60 credits this so far through mid-March or so. So it's going as expected, I would say.
Got it. Great. Thank you. Mark, thanks for joining us today. We know Kevin wasn't able to join us, so appreciate your being here for Fitch. Give us your perspective on what Fitch is seeing so far year to date. I know you have a neutral outlook on the sector, and just be curious to hear what you're seeing.
Hey, Robert, thank you. Thank you for having us. Really appreciate the opportunity to join my colleagues and friends here. Yeah, I think you're going to hear a similar. I'll echo much of what Suzie had to say. Is that we've had a neutral sector outlook now for the last almost a year and a half. It was in late 24 when we flipped the sector outlook from deteriorating to neutral. You could call that stable, I suppose. And really, that reflects our expectation over the next year, so now in 2026, that we expect relative balance in terms of the ratio of upgrades and downgrades, and relative balance in terms of positive outlooks and negative outlooks. And that has occurred. In 25, we definitely saw a normalization, I would say, of that ratio. We had a couple more downgrades than upgrades, but it was relatively close to 1-to-1 ratio. And so far, year to date, we're seeing that trend as well. And we expect that will likely continue. Again, our outlook is just a 1-year forward look. It's not a comment on where we think the industry is trending over the next 3 to 5 to 7 years, where we think there's some considerable headwind, and we can get into that later. But so far, 26 is shaping up to be a pretty decent year, actually, just in terms of bottom line performance. And obviously, there's been a lot of noise in the equity markets in the last couple of weeks with everything going on in Iran. But generally speaking, balance sheets are holding up. We expect that will continue to be the case. And of course, in this sector, balance sheet strength was a significant source of rating stability through what was a period of otherwise significant dislocation with a pandemic that was followed by a labor-demic, et cetera. We expect that will continue to be the case on the whole. So in an uncertain world with a lot of headwinds, we actually expect 26 will probably be a pretty good year. And I'm going to anticipate your next couple of questions here, in part, not despite, but in part because of HR1. A lot of management teams are really accelerating expense and savings initiatives, their AI initiatives, their top line revenue opportunities, looking under every stone to try to generate as much cash flow to improve their margins now in anticipation of what they expect will be coming down the road with HR1.
Yeah, that's great. That's helpful. And I guess maybe let's just start to turn the corner and talk about policy and reimbursement. And maybe Mark, we'll get you to go first. You know, as hospitals are budgeting now for 26 and 27, a lot of uncertainty in some states as it relates to state-directed payment programs. So how are you how are you seeing organizations handle that, I guess, number one, and how do you incorporate that into a rating committee on a forward view when it can be such a big number for organizations?
Yeah, absolutely. It's an excellent question, and it's difficult to define, difficult to answer, of course. But listen, as I mentioned, given the level of uncertainty, and really given what we know, what is known from a policy perspective is HR1. You really can't make any assumptions around the midterm elections, let alone the next presidential election cycle, and what that will mean in terms of give backs on Medicaid reimbursement or changes to directed payment programs. You have to go with what's known, and what's known is HR1. And as we all know, there's give or take around $1 trillion of expected Medicaid cuts over a 10-year period because of HR1. But about 75% of those cuts are in the last 5 years of that 10-year window. And really not much in the way of cuts, or almost nothing in 25, and then even 26 and into 27 are relatively de minimis. And because of that, there's time to adjust. And I mentioned this before. There's that time for management teams to identify their efficiency opportunities to generate as much of a margin now as they can. Now, there's certainly uncertainty state by each. Not every state's they're all the same. Certainly in terms of what their directed payment programs look like in those states and how they'll be affected by HR1 and the extent to which CMS will approve or not approve certain initiatives. So to your second question, Robert, as you know, Fitch's rating criteria is explicitly forward-looking. We look more to where we expect margins to be in the next 3 to 4 years, more so than where they are necessarily right now. And we stress that in the forward look. And to your point, it's difficult for management teams to tell us where their expected operating margins will look like in the next 3 to 5 years. But we're going to ask the question. We want to know that, given the uncertainty, what kind of steps are management teams taking now and what they expect to do over the next couple of years in order to maintain cash flow. A question that you're going to hear from us, some version of the question, is what kind of operating margin, operating cash flow margin does your organization view as sustainable? What is a target that you feel you have to hit in order to remain viable, in order to generate enough cash flow to reinvest in your physical plant, given all the uncertainties in the world? And most management teams are prepared to answer that question. Now, the number may differ by organization, and certainly differ by state, differ by market. They've given a lot of thought as to what kind of operating margin do we need to achieve in order to meet our baseline goals, and what do we have to do in order to get there over the next couple of years. So we expect actually in 26 and probably 27, the margins will probably be pretty decent. There's a lot of heavy lift happening right now in anticipation in advance of the cuts that, as of today, are expected to come under HR1.
Yeah, really helpful. I guess, Suzie and Dan, we'll get you to chime in a minute. Anxious to hear your thoughts, but I want to try to keep this thread going for a second. Mark, when you think about exchange enrollment, I guess we'd be curious to get your thoughts on sort of what you expect and the implications on financial performance for states haven't expanded Medicaid.
Yeah, so we're certainly expecting, and there's a projected decline in enrollment, health insurance coverage because of the changes, the reductions in ACA subsidies. We published a piece in late January where we identified every state in terms of high risk, medium risk, or low risk relative to this is specifically to the ACA enrollment question, not so much longer term with respect to HR1. And we identified a dozen states that we thought were particularly at risk in terms of the ACA enrollment policy or disenrollment policy. Generally speaking, those states are in non-ACA Medicaid expansion policies and have a high concentration of rural hospital providers, generally located in the Deep South and the Mountain West. Certainly there are variations there, there's degrees of risk, but that's sort of how we categorize things. And, there's expected to be around a $4+ million net reduction in enrollment because of the ACA subsidy changes. It's an estimate. The actual number may vary. Certainly, again, some states are going to be hit harder than others. But again, we identified a dozen states that we felt were particularly at risk, and we'll continue to monitor what that means for bottom line performance for hospitals in those markets.
Yeah, great. That's super helpful. Suzie, we'd love to get your thoughts on this as well.
Yeah, I think just in terms of HR1 and, similar to Mark, I think what we're seeing is that organizations are providing some forecasts. I mean, and again, I think the Medicaid's a little bit more difficult to forecast in terms of who's going to come off and who's going to stay on. But, there are estimates. And I think to Mark's point, they provide guidance in terms of what are the initiatives that you need to put in place. And I think we also wrote about that in our we've been writing about it in our outlook that we do feel that organizations are doubling down on the performance side of things. And it's also, it sort of bleeds into strategy, but they are, even the ones that are doing very well right now, very focused on operations and making sure that's all fine tuned, given what might be coming. And I think, we are getting estimates on the provider or on the supplemental numbers, and like, it will be, starting in 28 more, and it is incremental, right? So there's still time. And I think given that they are so focused on those initiatives, we also expect that, we may see a little bit of, stability to improvement. There's still some, negative headwinds. So maybe at least keeping things at least stable, hopefully a little bit better as they go into these years where they are going to expect the cuts. So I think it's very similar in terms of Mark's context. And I think on the exchanges, we also are looking at some of those states. And I think it'll be, again, we're seeing some big numbers. And I think that's part of the strategy to sort of make sure that you can manage. And I think part of what we're seeing is that organizations are thinking about, well, they're still going to come in and they may be bad debt. So it may be a worst case scenario, and hopefully it won't be as bad. But I think that gives organizations at least some ability to sort of manage and think strategically about the operational improvement they need to get to hit those numbers, because they still, many are still not at the numbers that they want to be at from a margin and cash flow perspective.
Are you seeing hospitals providing estimates for the impacts of HR1? Is that coming out in rating meetings? And I guess I'm curious how that's viewed by the rating committees.
I think for us, we are seeing estimates. We understand that those could change, specific, because the states could be doing different things. This is just their best guess. But again, it gives us a view of how they're thinking about it and what kind of hole they may need to fill. So I think the less dependent you are, the less maybe we're seeing on that. But the more there's definitely, for many providers are providing that.
Got it. And I guess, curious to get your thoughts. So if a hospital provides you with estimates that sort of demonstrate lower financial performance ahead, is that viewed negatively? Or, how would you, a little bit damned if you do, damned if you don't, right? So.
Well, I will say similar, you get your budgets for 26, maybe 27, a forecast. And we do get forecasts beyond that. But I think the idea is that there are a lot of things that organizations can do to kind of get back some of that. So while we may see big numbers kind of going out 29, 30, it just helps, I think, us to understand how the system is thinking about it. It doesn't mean that we're, about to downgrade them just because we see those numbers. It's about what are you doing between now and then?
Yeah. Dan, I see you nodding your head. Is there anything you want to add before we?
Well, yeah, two thoughts. One, just in terms of like the presenting the numbers in a challenging period coming up, is sort of what you're alluding to, Robert. I mean, we know it's going to be challenging, so I think it's probably more of a disservice to sort of brush it under the rug and pretend like it's not there. It's going to require management teams to be creative and get ahead of it now. It's interesting when the bill was first being debated in Congress. At a couple meetings where folks presented some really, really challenging, multi-year scenarios of hundreds of millions of dollars of impact, and those have since been walked back and got a better sense of how meaningful the actual financial impact is going to be. So it's helpful to see that progression, that thought progression. Yeah. The other thought I have too is just, with the methodology that we're going to publish here in a few weeks, this is specifically what quality of revenue, or one of the factors that quality of revenue is intended to address. And the fact of the matter is, these types of impacts vary state by state, Medicaid expansion or not, how significant the exchange growth has been in a given state. You have areas like South Florida that are seeing a pretty big drop off in exchange enrollment. And it's not uncommon to hear, that the exchange prices went up, especially there's a number of integrated delivery systems that we rate and everybody here on the call works with that, put forth 20% or more rate increases on their exchange products. There will be some adverse selection. The numbers aren't finalized yet. I mean, you know, we will have a better sense of how many people are actually paying their premiums and remaining insured in the middle of the summer than we do now. So there's, you know, the point being that as more information comes out and we're updating assumptions and updating forecasts, it's that's just a part of the process.
Yeah. That's helpful. Thanks. Suzie, sometimes the S&P reports will discuss reliance on state funding as a credit challenge. Is there a specific threshold in your mind or a level that sort of really gets you nervous in terms of dependence on, you know, margin? You know, is it 50%? Is it 80%? When does the alarm bell go off?
You know, it's it's typically not one thing that's going to lead to, you know, a rating action. So even as that number moves, but it's incorporated. It's somewhat incorporated into the rating as we're seeing it, and may limit some upside depending on, you know, where the rating is at for a particular organization. But it just goes to the overall like diversity, you know, maybe to Dan's point, the quality of the revenues that you're seeing, and where is that coming from? And is it, you know, not all of it's going to get cut, but some of it's going to get cut, and then it goes back to the, okay, what are you going to do about that? You've done well with it here, but it's going to be maybe slightly lower. So what's the strategy from there? So there's not a number, but, you know, we certainly, you can see them in all the tables that we publish. I mean, not some of that's, you know, we have all the supplemental funds in there. So it's also DISH, it's other things, but the majority of it is provider taxes and directed payment program funds. So you can see where that's at. But and so that's kind of how we think about that. There's no sort of threshold per se.
Yeah. So when you think about revenue uncertainty, you know, how does the absolute level of cash or days cash on hand, how's the importance of that factor into the rating committee?
I think for us, I mean, you know, your balance sheet flexibility is key, especially when you think of all these unknowns, right? And you know they're coming. You've got a couple years, maybe a year and a half, but that definitely provides cushion for lots of things that could happen over the next, you know, couple of years. So whether it's a cyber attack, whether it's something else, that balance sheet is very key, and we've seen a lot of focus and you know, and the good news is that that's holding up. I don't want to look at what the markets are doing today or anything, but it's, you know, it's been holding up, and that is a key aspect of some of the. It does give some flexibility as you're working through some of these challenges. The more, you know, the more balance sheet strength you have there, for sure.
We're going to talk about balance sheet in a minute, and so we'll come back to that. But I guess before we do, Dan, anything else you want to share about strategies you're hearing about in terms of what hospitals are doing to prepare for funding cuts?
Well, I'd say labor and productivity are always the, you know, big areas to get sort of big bang for your buck. I mean, there's all kinds of regulatory work, I would say, that organizations are doing just to make sure that they're out in front of their state representatives and working with them. You know, there's a number of preprints before CMS right now that a number of states and organizations were pretty active in getting those out in front of the federal government to increase funding as much as possible ahead of the reductions. But I would say a lot of blocking and tackling is where you're seeing most organizations focus right now. I think probably as we get closer to eligibility changes for Medicaid, you're going to see a lot more work just to make sure that people know what insurance coverage they're actually eligible for, and working with individuals to make sure that they're actually signed up and maintaining their coverage. I think we're going to see a lot more emphasis on the reporting requirements and helping individuals meet those requirements in order to maintain coverage. But other than that, I think what Suzie and Mark went through is pretty comprehensive.
Yeah, this is an important topic, and so before we turn it over to Lisa to ask some questions about, you know, financial performance and balance sheet, et cetera, is there anything we haven't gotten to touch on that the group would like to sort of provide in terms of insights or you're hearing and seeing?
I think one thing Dan might have mentioned is just strategically, you know, I think there is a lot of focus on throughput and productivity and access. growth to help offset, some of what's coming. And I think some of that service line optimization and really kind of getting into some of that stuff as well to longer term or medium term, to try to offset some of the challenges coming.
One fine point maybe to put on that is I think the industry as a whole is getting readier, if that's a word, for site neutrality, particularly as we're talking about new projects. I was just with a system the other day. We were touring what was really a beautiful outpatient center that it was more than an urgent care plus, and it was less than a freestanding ED. So whatever the latest term should be for that. But it was really well done. And we started having a conversation about if this, how the financial profile of this would be under pure site neutrality. And they talked about it as a road, a journey, but that they're almost there for this, this particular facility, and less intensive facilities of theirs that are more on the urgent care side. That they're just so much lower cost, it wouldn't be an issue. But that the point of the conversation being that it was being approached less from a how do I leverage the rules of the system now so they make sure all of my facilities are hospital-based reimbursement to no, this will happen, and I need to be prepared from a cost structure for this place to live on its own bottom in a site neutrality world.
Yeah. Great. Well, Lisa, you want to take over?
Yeah, for sure. This has been a great discussion. We've got some questions coming in, but while we're on the topic of capital, Dan, you just mentioned touring a new facility. We'll start with you. What are you seeing in terms of capital spending, capital trends, and where more recent focus has been?
Yeah, it's ticking up. We actually just published an infographic a couple of weeks ago talking about how much capital has been deferred since the pandemic. And the headline number that we have for our portfolio is 16 billion. But the point being that what you've seen over the last 5-6 years is organizations deferred capital where they could, issued less new money debt, such that debt to revenue, for example, had been around 33 to 35% pre-pandemic, and it is now under 30%, about 27% now. So organizations issued less new money debt. Some marginal projects were pulled back. Some other projects, the timeline of them was postponed or extended, such that the capital spending ratio decreased over the last several years to around 1.2 from 1.3. And age of plant ticked up by about 2 years. And all of that represents some deferred capital. Now, there's other factors in there, admittedly, increased spending on software that tends to be expensed as opposed to capitalized. That would, muddy the numbers here. But the general direction of travel is clear. And what we've seen now over, I'd say, even going back to last year, and it's really accelerated over the last few months, is organizations coming back to the market for new money debt. A lot of projects that, already began, so some of that is going to be reimbursement financing, but organizations really spending more on creating more access points, addressing some of those major projects that maybe they had put off or that were second order. And we are all in expecting this to be a pretty robust year in terms of spending. Now, recent events in the Middle East might throw all that for a loop, especially if, we get a big bout of inflation. But putting that aside, coming into this year, we were expecting pretty robust capital spending.
Mark, did you want to comment on this as well from the Fitch perspective?
Sure. And I'm going to tie this a little bit to some of the comments that were made about strategies, in that we're starting to hear from some management teams, maybe the bit more sophisticated folks, who when they're tying explicitly strategies to capital deployment and really doing a detailed analysis of what they expect to be the effects of HR1. And by the way, I saw there was a question on what is HR1, and HR1 is simply another shorthand name for One Big Beautiful Bill Act, which was the Comprehensive Tax and Spending Act that was passed, I guess it was last summer. So that's our shorthand is HR1 for this call, I guess. And doing a detailed analysis as to what they expect the effects of HR1 to be. And linking to that here's the headwinds we're facing. Here are the margins we need to generate. In tying that, here are the capital that we hope to do based on certain level of margin generations. If our cash flow generation is short compared to where we hoped it to be, if the margins are a little bit lighter, then we identify those projects that are less critical. I would say in general, I agree with Dan. There's certainly a bit of makeup for some deferred capital. We are seeing a bit of a ramp up in capital spending this year, but there's a conversation I'm hearing from some folks around. We need to be explicit about what our capital spending plans will be in the context of where the operating margins for our organization will be. And if we're 3+% operating margin, we can pretty much do all the hoped for projects. If we're more like 1 to 2%, we're going to have to scale back a little bit. If we're barely breaking even, the CapEx is really going to start to take a haircut, and that gets overlaid explicitly into how we view that forward-looking assessment as to where margins will be and what balance sheet strength will look like. Obviously, our health systems that have very, very strong balance sheets, if you've got 500 days cash on hand and 400% cash to debt, you can see through the noise. You can move forward with your capital deployment as you see fit because your balance sheet can support that. But I don't think this is rocket science necessarily, but a little bit more thought, I think, going into tying operating margins, expectations for operating margins, and what that will mean for the when, the how, and the what of capital deployment.
Mark, let me pick up on your theme there. You're talking about operating margin. We know and we've seen in 2025, many hospitals, health systems had very strong market returns, investment income, very strong. What is your view on investment income as a source of cash flow? The higher, the better, or is it a sign of stress on acute care, operating income percentage and performance? How do you feel about that relationship?
Yeah, great question. I certainly, cash flow is great. I mean, regardless of where it comes from. But we're gonna focus, generally speaking, for most of the providers we rate on their operating EBITDA margin, their ability to generate cash flow from core operations. I think most management teams manage to that mindset that we need to be at a 2 to 4% operating margin and a 7 to 9% operating EBITDA margin, and then whatever we get from the investment returns is gravy, if you will. Now, there are a few exceptions to the rule. If you think of some children's hospitals, for example, if your operating model is your balance sheet is so strong that the cash flow generated off of investment returns is a fundamental component of your operating strategy, it's a good problem to have, I suppose, in that regard. Not everyone has 600 days cash on hand, or 4 times as much cash as debt. But those, I think, are the exceptions, not the rule. Balance sheets are great. The stronger, the better. The more cash you have on hand, that certainly, again, we saw this through the pandemic. We saw this through the subsequent labor-demic in 22 and 23, that having a very strong balance sheet can help weather the storm, help get you through the headwinds. But we generally speaking, we look to core operating strength for most of the credits in our portfolio.
Suzie, would love your comments on capital spending, what you're seeing, especially if performance, as indicated perhaps by fewer downgrades, is improving.
Yeah, I mean, very similar in terms of we are seeing that pick up. Early median, we're starting to look at some of the numbers for 25, early 26. Capital spending is up across, I think it'll probably come through in the medians. It is on various, depending on the organization, strategic projects, whether it's ambulatory. We also see a lot of inpatient. Some of that may be deferred to having to go back in, or it could be just expansion just because there has been such demand on the higher acuity services. So it's a mixture. And then, as Dan mentioned, a lot of IT and data, which doesn't really come through on the capital side, but comes through on the operating side. That's where a lot of the investments are from. And I think similarly on the investment income, it's good to have it. Certainly, it helps to build the balance sheet, but it does depend on how the organization's thinking about that investment income and what they're using it for. There are credits where it's been a really good couple of years in terms of investments, and so your cash flow, your coverage is looking great, but 75% of that's your investment income that you had. It's just something to kind of think about as you're looking to the next, how are you going to continue to fund, as Mark said, your capital needs, your operating needs, if that comes down, because it's certainly been a bumpy first quarter. So I'm not sure if that's going to be an indication of the rest of the year, but that could come down. So, how are you going to think about what you need to do, whether it's operating or capital, and what improvements do you need to make so you can shore up that, if that is, if the operating side is a little bit weaker than the in the non-op side, which is mostly the investment income.
So when you say, just to be clear, on bumpy first quarter, you're talking performance.
Investment performance. Sorry.
Investment. Okay.
Yeah.
Got it. Well, on the topic of capital, we have on our list, and indeed one of the writing questions is about off-balance sheet debt, different products, different vehicles, your perspective, specifically the question, we have a write-in on energy service agreements or energy as a service, how you're viewing these. And the question writes, viewed as a sign of stress or financially savvy. So who would like to take that question first? We'd love to get everybody's opinion. Dan, go ahead.
I think it's an interesting question, particularly on the stressed versus financially savvy.
Yeah.
To sort of address that head on, it's not. I wouldn't say it's in and of itself a sign of stress. I mean, it's a different financing arrangement that is out there, and I think it's helpful also to break it into various constituent parts. I mean, just to be very clear, to say up front, we do consider it debt-like. We will add it to your debt stack and treat it like an operating lease. So just to be very clear on that, because I think at different times I've heard confusion out there, or sometimes an organization will come to us and say, oh, we're hearing one thing, we're hearing something else from someone else. So we do consider it debt-like, even despite the accounting treatment that, will treat it as deferred revenue. So in terms of is it savvy, or is it the questioner was the person posing the question was questioning the economics of it. And I think there's different components of it. There are some deals that really are just focused on how to finance the capital upgrades that you are looking to do that are either going to reduce your energy consumption or help you meet emissions targets, or other capital upgrades that you just need to do on your energy infrastructure and distribution and hot water and chilled water and all the different elements that can go into the projects that underlie the the financing. And then there's a component of the financing that can be seen as just an alternative financing arrangement where you're borrowing additional money through the special purpose entity that's set up to effectively be like the conduit for the financing. So I think those two pieces are different. To the extent that the special purpose financing is a higher cost of capital, which I think sometimes it can be, that's a question we'll ask or consider. Why do that? But there's a component of the financing that is addressing specifically these capital and energy infrastructure needs, and I think going this route is one option among many, and it doesn't necessarily indicate stress or savvy. I think it's an option. It's a part of the the available toolkit that's out there. But I think the question that we have and that we always discuss with the management teams is why do you need to do these projects? What how do these fit into the larger strategies that we're all discussing? I mean, energy and providing, the proper infrastructure at the hospital, it's sort of the necessary blocking and tackling. It's not as exciting to talk about that, quite frankly, as it is, your new hospital or new ambulatory center or new market, but you need to do it. So how you finance it is just a part of that question. And I don't think we have an opinion that one form of financing is better than another. I mean, certainly if you're doubling your cost of capital to do it one way, we're going to really question that. That's not what we're seeing out there typically. But in some cases, it is a higher cost of capital, or for a portion of the financing, it's a higher cost of capital, and that will invite some scrutiny.
Okay. And just to put a point on this, Dan, proposed scorecard brings in adjusted debt in all of its flavors with various adjustments to be made, which I understand is nothing new, but just.
That's right.
Yeah.
But it's formally in the scorecard, and this financing would be in those numbers as well.
Suzie, let me give you a chance to respond and share your thoughts.
Yeah, we do consider it a liability. We consider it a debt-like instrument as well. It could be using up some of your debt capacity if you do a project like this, but understand that, you know, this is something that has to get done as well. So in terms of, I think the question that, or the question that Dan raised about why are you doing this? And do you understand all the risks of doing this versus a different strategy, and just and sort of walking through that is a question that we want to make sure that the organizations understand and how they're thinking about it. You know, they do sometimes offer guaranteed savings on things. So get that a lot of these partners have expertise in that area, which maybe a hospital doesn't. So understand that. But it is very much why are you doing this? What are the risks? It certainly can be helpful, but it can take away, we do treat it like debt. So it may take some debt capacity. It could change your outlook, could change your rating if it's enough, because we've seen some sizable ones. So it's just a question for any particular, it will vary for every, in terms of how much it affects it, but that is how we look at it. So I guess just to make it clear that it is viewed as debt of the hospital.
Okay, Mark?
Yeah, I'll echo all the same kind of. Listen, it's a debt equivalent. It is. Sorry. It's I'll say this. At the end of the day, it comes down to is this going to affect my rating, right? And I am hard pressed to see a scenario where an organization that enters into an energy as a service contract or something similar that results in an upgrade because of this. Now, I think for many, it's probably de minimis and maybe sort of a neutral item. We've seen a lot of this in higher ed, actually. So probably start to see more of it in healthcare. And to date, it tends to be larger, more sophisticated organizations that have good balance sheets. So frankly, for most of what we've seen, it's not really a credit issue. It'll be interesting in the coming years as we see this move down the rating scale. If we see more triple B, borderline investment grade, not investment grade type credits that explore these opportunities, that inherently will result in more scrutiny and more questions about, do you understand what you're getting into? Do you know the long-term ramifications, or short-term as well? But today, I don't really expect to be much of a mover in terms of ultimately to the rating. But if it's significant relative to your scope of operations relative to your existing balance sheet resources, it could. But again, hard pressed to say that it will lead to upward movement on the rating. And we have actually had that question posed to us before. But it's another tool in the toolbox that can have its uses, and we'll ask the appropriate questions as it's presented to us.
So Mark, Fitch, all about the forward view. When you have this program come to you by an issuer, do you want to see projections? Do you want to see the savings that this will generate?
Yes, absolutely. I mean, we always want to see projections. I mean, that's not every organization provides them, but it's always great to have. Just an understanding of where your health system expects to be over the next 3, 4, 5 years, recognizing all the uncertainty in the world. In terms of savings, we want to see that should be absolutely incorporated into your forward-looking projections as to what kind of savings these can generate, and recognizing that we're going to look at this as a debt equivalent, and how do those balance off versus one other thing. For some of these, the payoff is the duration can be quite long. And just inherently the way the math works, the longer you go out, the more uncertainty there is, right? I mean, that's just sort of a given. And while our ratings are forward-looking, they're not 20 years down the road.
Yeah.
I'd be curious to hear that, but that's not exactly where our window is for the ratings. But the extent to which we can We want to see projections and that these savings can be incorporated into it. Absolutely, we want to see that.
Okay. So Suzie, let me go back to you for a moment, kind of where we started today. Fewer downgrades year to date, a couple of upgrades due to fundamental financial improvement, not necessarily acquisitions, which is okay as well. If you had to characterize or list, say, the top 3 reasons why financial performance is improving, what would you say they are? The overarching, yeah.
Yeah, I think revenues and volumes are one aspect. I think for a lot of places, they've high acuity services, and the volumes have been very sound. I think on the expense management side, the labor, there's pockets there's still stress. There's still, maybe stress isn't the right word. There's still some challenges there in particular pockets in certain markets or certain specialties, but in general, labor is being managed very well. There have been a lot of staffing adjustments over the last couple of years, more work on productivity and throughput and those kinds of things. So kind of the expense and the, doing more with what you have. I think that's another aspect. And then it was performance, right? The question was on performance.
Yeah.
I mean, certainly the investment markets have helped. I mean, that's not necessarily operating performance improvement.
Right.
I think the supplemental funding has really helped a lot of organizations over the last couple of years, and it's much more widespread than it was 5 to 7 years ago, how much money is coming in from that. So not saying that that's everything. And certainly, again, it depends on the market, because in some places it has been a big boon. But I would say those are probably the 3 things, is just the volumes, the labor, and maybe one other. I think there is, as I mentioned, management focus on, and just sort of the blocking and tackling and just stronger management skills on a lot of those things. So I would just give management some credit on a lot of this.
Okay. Mark, one of the things you had mentioned again early on, looking at current financial performance being more stable, better, you mentioned AI. So let's spend a few minutes on artificial intelligence. What can you quantify or talk about what you're seeing? How do you feel when you meet with a hospital maybe that doesn't have the means to invest or explore AI? Are you measuring yet a return on AI investments? Is there such a thing? Do you want to pick up on this thread?
Yeah, a lot of great questions there.
Yep.
So qualitatively, I expect that AI is going to come up in every conversation. If it doesn't, I don't want to say I'm concerned, but it sort of has to. There has to be some strategy around, both from a clinical deployment perspective, back office, HR. There's a lot of uses that AI can be used to help drive efficiency in the organization. You at least need to be thinking about it at a minimum. Now, the flip side of that is it quantifiable? It's not. And anyone who tells you it is sorry, it just isn't. You look at the macro economy, there's actually very little evidence to support that AI has driven any kind of meaningful productivity improvement in the broader economy. It will. It might be 10 or 15 years down the road. That was our experience with a lot of other emerging technologies over the last 50 years. I don't really see why AI would be any different. But to date, it's really a matter of, we're in the stage of, now this isn't just a healthcare comment, that's just the broader economy for pretty much every business, is how can this be used? There's going to be learning hiccups along the way. Some uses will kind of flop and others will really be big bangs, but we're very much at that learning stage. I think in some regards, and again, this is a qualitative comment, it's almost more the clinical side where we're starting to see some or hear some positives of AI. Just to give one example, is that ambient listening, right? Really affords the doctor and other clinicians the opportunity to have a conversation and make eye contact with the patient. And what is for many patients one of, if not the most important conversation they'll have in their life. And we're sort of gone. We can use this tool as opposed to maybe even just a couple of years ago, you could have a situation where a doctor just has their back to the patient, typing notes at a computer, and you miss that disconnect. I think that again, there's a lot of opportunities here in terms of both clinical and back office things that can drive meaningful efficiencies and savings for organizations. It's not being quantified yet. We'll ask the question. It's interesting the kind of answers that we get. I think the early results are relatively positive, but we're still very much in the learning stage. And to your other question, Lisa, the learning stage is typically driven by the organizations that have the resources to deploy a comprehensive AI program and can accept the fact that some of their initiatives will not work. And that's okay, because you have to take some risk, right? I think the health systems that are maybe not as financially strong, don't have the balance sheet, maybe don't have the sophistication, it might be a year or two for them. They're going to have to learn from others. It'll be interesting, and one of the things that we're going to track over the next couple of years is the pace of M&A activity in the sector, and that's kind of a separate conversation topic, I suppose. But could AI be a driver for M&A? I think it might be. It's almost, you think of like a number of years ago when some hospital systems just didn't have the means to invest in an electronic medical record system. Mm-hmm. And that was a catalyst for partnerships, for M&A activity. Could AI be the same kind of? I think it might. I haven't seen it yet, but I think it'll be interesting in the next couple of years if we see that as a, some small rural hospital that says, we wanted to stay independent, but we just don't have the means to deploy these new AI tools. We have to partner up just to help drive additional efficiencies for our health system. So that's it.
Okay. Dan, did you want to comment on this?
Oh, there's a lot to say. AI.
Yeah.
I'll just add one thing on the rev cycle. We're hearing, unfortunately, a lot of AI. Pardon me. We're hearing a lot of AI being deployed on rev cycle, and it's the bots fighting the bots, which seems like an unfortunate way for that to go. But no, it's the type of thing where I think there's a lot of progress being made on some of the clinical and scientific research sides of it, on the administrative, whether that be rev cycle or administration or HR. There's a lot of efforts underway, and it's I don't think we've seen sort of like one like really clear, this is a great example of an organization that's out front and has really saved a lot of time and therefore resources, and to Mark's point, created economic gain from this this one deployment. So I think we're still seeing it develop.
Okay. Suzie, last word on AI. Any additional thoughts?
Yeah, I think there's lots of different things going on in the sector on this. Yeah. I think, as time goes on, we'll, I'm sure, see what's working, what's not. We're starting to hear more about system-wide things that maybe could be put in place, like scheduling and things like that, that could help. But I think we are very much in the early stages, but we are asking a lot of questions about what sort of infrastructure you have, what kind of data do you have, how are you getting ready for this? Because Mark said, if you don't have any thoughts, that's probably, you don't have to have, there's not one thought, but you should probably be thinking about how it can help you. And, whether you're building it or whether you're working with partners or whether you're working with Epic, just kind of having some initial thoughts would be at minimum.
Okay. And the governance over all this, right? Like as with any strategy. Okay. So we're almost at time. Let me just do a show of hands. Do you still want to have issuers, hospitals talk about cybersecurity? Show of hands if that's a yes. Okay, we got it. All right. Robert, back over to you, sir.
Good. Well, listen, thank you. I want to thank our panelists for being with us today. Your insights are just so valuable. I want to thank the audience for being here. We hope you find this informative. We'll publish a synopsis of this in the coming weeks, and so look for that to come out shortly. But again, just want to thank everybody for your time.
Thank you.
And thank you, Robert and Lisa. Our special thanks to our panelists and to all of you for attending today's webinar. Look for an email with a link to a recording of today's webinar within the next day or two. Have a great rest of your day.